Ladies and gentlemen, friends, I stand before you today not to persuade you in the moment, but to wake you up. When history speaks loudly, we ignore it at our peril. Today, I bring what I call a final warning about silver, not as a doom prophet, but as someone who studies the machine of the economy, observes cycles, and sees imbalances that too many are overlooking. When you look at silver through the lens of the long-term macroeconomic cycle, what emerges isn't a simple commodity story. It's a reflection of how money, credit, and confidence interact over time. Every asset class plays a specific role in the economic machine. And silver, though often overlooked, is one of those assets that exposes the underlying shifts in the global order before they become visible in mainstream markets. It's not just about price. It's about what that price is telling us about the structure of the system itself. Every few decades, we reach a point where debt burdens grow unsustainably large, productivity gains slow, and the tools policymakers use to stimulate growth start to lose their effectiveness. This is where we are today. Central banks are trapped in a feedback loop. They can't tighten too much without breaking the system, and they can't ease too much without fueling inflation and devaluing their currencies. These moments of constraint mark the late stages of the long-term debt cycle. Historically, this phase is when alternative stores of value rise in importance and silver becomes one of the quiet beneficiaries. Silver's behavior during these transitions is unique because it sits between two worlds. It's both an industrial metal and a monetary hedge. On one side, it's tied to the real economy used in solar panels, electronics, medicine, and technology. On the other, it's a psychological and historical refuge. When fiat currencies weaken, this dual nature gives it a split personality and understanding that is essential. When industrial demand surges and inflationary pressures rise simultaneously, silver tends to experience explosive upside moves. But when monetary tightening occurs alongside weak industrial growth, it can correct sharply. The key isn't to predict the short-term direction, but to understand the larger structural forces shaping its role. The macro environment we're in today mirrors the late stages of previous great cycles like the 1930s, the 1970s, and to some extent the early 2000s. We have record levels of global debt relative to income, persistent fiscal deficits, and the erosion of trust in fiat money. These are the same ingredients that over centuries have forced a revaluation of what people consider to be money. When the purchasing power of currency erodes, tangible assets, especially those with limited supply and broad utility, start to behave differently. Silver fits this mold. If you track the behavior of silver against the long-term debt cycle, patterns become evident. In the early stages of expansion, credit creation fuels productivity and growth, keeping inflation subdued. Silver remains largely quiet during these periods because real yields are positive and financial assets offer attractive returns. But as debt accumulates and monetary authorities resort to printing money to sustain the illusion of stability, the real value of paper assets begins to deteriorate. Inflation expectations rise and confidence in central banks declines. This is when silver starts to wake up. It doesn't move first. It reacts when the credibility of money itself comes into question. We saw this dynamic in the 1970s when inflation ran rampant and both gold and silver went parabolic. The U.S. had come off the gold standard, the dollar was losing credibility, and investors sought safety in tangible assets. But that spike was not random. It was the culmination of years of monetary excess and policy missteps. The same structural pressures exist today, but on a much larger global scale. This time, it's not just one currency or one country. It's a synchronized imbalance, rising debt to GDP ratios in almost every major economy, a shrinking middle class, and the dilution of real purchasing power. Now, it's important to understand that silver doesn't always act rationally in the short term. Market participants often misprick it because they view it either purely as an industrial metal or purely as a monetary hedge depending on the mood of the economy. but over the long term, silver tends to adjust to reflect reality. When currencies are devalued, whether openly or through inflation, silver compensates by revaluing itself. It is in essence a mirror that reflects the integrity of monetary policy. When that integrity weakens, silver strengthens. What we're witnessing right now are the early warning signs of that process. The global monetary system is being strained. Central banks are intervening more frequently and in more unconventional ways. Liquidity injections, yield curve control, and balance sheet expansion have become permanent features rather than temporary tools. These actions delay pain but increase fragility. Every time money is created without a corresponding increase in productivity, the long-term purchasing power of that money declines. Silver, being finite and tangible, doesn't respond to these distortions with emotion. It simply revalues to compensate for the excess creation of currency. When you look back through history, you'll see that silver often moves in violent bursts. It spends years consolidating, then suddenly reawakens as if remembering its true purpose. These bursts usually coincide with the late stages of debt cycles, when the gap between financial reality and underlying productivity becomes too wide to ignore. The 2008 financial crisis was a reminder of this dynamic. Massive liquidity injections were required to stabilize the system, and silver responded by rising from under 10 to nearly $50 within 3 years. That wasn't speculation. It was the market recalibrating itself to a new monetary reality. Today, we are again approaching that kind of environment. Real yields remain negative when adjusted for inflation. Fiscal deficits are widening, and geopolitical fragmentation is accelerating. The global order that supported the dollar as the world's reserve currency is weakening as countries seek alternatives in trade and reserves. These shifts don't happen overnight. They unfold over years, but the signals are clear. Silver's role in this environment is not to replace money, but to act as a warning signal that the system is reaching its limits. When monetary policy becomes a political tool, when debt monetization becomes normalized, and when trust in the financial system erodes, tangible assets begin to take on new meaning. Silver, in this sense, becomes a gauge of confidence. When people believe that printed money will retain its value, silver drifts sideways. When that belief cracks, silver becomes volatile and reprices rapidly. It's not speculation. It's a function of how money works when faith begins to decay. The next stage of this macro cycle will be defined by how policymakers handle this fragility. If they choose to inflate their way out of debt, currencies will lose value over time and silver will likely surge. If they attempt to tighten aggressively, they risk triggering deflationary shocks, defaults, and political instability. Either outcome leads to rebalancing, and in both cases, silver has historically played a defensive role. It's not about betting on one scenario, it's about understanding that we are already in the process of transition. Another layer to consider is supply. Silver production has been under pressure for years. Many large mines have plateaued and new discoveries are declining. Meanwhile, industrial demand driven by the energy transition, electric vehicles, and electronics is rising. This supply-demand mismatch amplifies the monetary story. When the financial and physical markets align in imbalance, the repricing can be dramatic. What makes this moment distinct from previous cycles is that the world has never carried this much debt, nor relied this heavily on fiat expansion. The leverage embedded in the system, sovereign, corporate, and household, is unprecedented. It means that traditional policy tools will be less effective. Central banks can print liquidity, but they cannot print trust. They can support asset prices, but they cannot manufacture productivity. As this reality unfolds, tangible stores of value will likely regain prominence. Silver, because of its smaller market size compared to gold, reacts more violently to shifts in sentiment. That volatility is both its risk and its opportunity. Investors often ask when silver will move. The answer isn't in charts. It's in the behavior of policymakers, the direction of real interest rates, and the sustainability of fiscal policy. The moment markets begin to internalize that debt can no longer be normalized without inflation, the repricing will begin. It always starts quietly, then accelerates. That is how cycles unfold gradually, then suddenly. It's also critical to approach silver not as a get-rich asset, but as a strategic component in a broader system of balance. The purpose is not to speculate, but to hedge against systemic fragility. In portfolio terms, that means using silver to offset the weaknesses of paper assets in late-cycle environments. Just as one wouldn't hold all cash during inflationary times or all equities during deflationary collapses, one must diversify across assets that behave differently under stress. Silver's low correlation to traditional financial assets makes it useful when uncertainty rises. The biggest mistake investors make in late cycle phases is assuming that what worked over the last decade will continue to work. But cycles reset. What performed during a period of easy money and low inflation will often underperform when the pendulum swings toward tightening, fiscal strain, and currency devaluation. Silver doesn't perform well because of optimism. It performs well because confidence is eroding elsewhere. As we move deeper into this latest stage environment, the warning signs multiply: rising sovereign risk, currency volatility, protectionism, and political polarization. These are symptoms of a system struggling to rebalance itself. Each time confidence falters, tangible assets provide a form of insurance. That is silver's macro role. It is both a hedge and a messenger. The lesson here is not to idolize silver, but to understand the context that gives it power. The long-term debt cycle is in its final innings, and monetary authorities are managing appearances more than fundamentals. That kind of environment doesn't end quietly. It resolves through some form of reset, either through inflation, default, or restructuring. In every past instance, tangible stores of value regain prominence. Not because people suddenly loved them, but because they needed something they could trust when promises were broken. Silver's final warning is not a prediction of collapse, it's an observation of imbalance. It tells us that the system is stretched, that confidence is thinning, and that policy tools are losing potency. If history rhymes, then we are nearing the point where the gap between financial illusion and real value will close. And when that happens, those who understood silver's role within the macro cycle will not be surprised. They will be prepared. When I think about risk, I don't think about it in terms of how much money can be made, but how much can be lost. The most important lesson that the markets and life teach you is that preservation always comes before speculation. The people who survive and thrive across cycles are those who structure their positions in a way that even if they're wrong, they don't get wiped out. The ones who fail are those who overestimate their certainty. Silver, like all tangible assets tied to monetary instability, must be viewed through the lens of asymmetric risk. It is not an asset to chase for excitement or emotion. It is an asset to hold because its risk-reward profile under specific macro conditions is fundamentally skewed in your favor. The potential downside is measurable, but the potential upside in the right environment is exponential. That imbalance, that asymmetry, is what makes it valuable when the system begins to shake. Asymmetric risk means positioning yourself so that you can endure being wrong, but stand to gain substantially if you're right. In the context of silver, that means structuring your exposure so that even if prices remain flat or decline moderately, your broader financial health remains intact. But if the macro environment shifts, the kind of shift that happens once or twice in a generation, silver can reprick dramatically upward, and your small calculated exposure becomes disproportionately rewarding. This principle of asymmetry is the foundation of all sound investment thinking. You never want to rely on being right, you want to rely on being balanced. Most people make the mistake of betting on certainty. They decide this will happen, and they structure everything around that belief, but the truth is we live in a world driven by probabilities, not certainties. The best investors are those who design for both outcomes. They stay alive when wrong and benefit massively when right. That's how wealth endures through the chaos of economic cycles. Silver is a classic example of optionality, an asset that offers a low probability but high impact payoff. Optionality is the ability to benefit from extremes, from dislocations, from unexpected outcomes. Most people think of options in the financial sense, contracts that give you the right, but not the obligation to buy or sell. But the concept extends far beyond that. Real optionality in markets means owning something that becomes valuable precisely when the rest of the system breaks. Silver has historically played that role. When everything functions normally, when confidence in central banks is high, when fiat money is stable, and when growth is steady, silver behaves like a commodity. It fluctuates with industrial demand, with energy prices, with manufacturing cycles. But when the system's stability begins to fracture, when inflation outpaces interest rates, when debt becomes unsustainable, when currencies weaken, silver stops acting like a commodity and starts acting like a monetary release valve. That transformation is where asymmetry lies. The beauty of this dynamic is that you don't need to predict exactly when it happens. You just need to recognize that the system eventually reaches such points. Every cycle throughout history has produced moments when confidence in paper assets collapses. The timing is uncertain, but the inevitability is not. The cost of maintaining exposure to something like silver during calm periods is small compared to the payoff when the storm arrives. Think of it this way: holding silver is like keeping a life raft on your ship. When the sea is calm, it seems unnecessary, just dead weight and expense, something you barely notice. But when the storm comes, it becomes the most valuable thing you own. That is how optionality works. You're paying a small cost today for the right to survive and potentially benefit when others are drowning. The market rarely rewards comfort. Most people buy when it feels safe and sell when it feels dangerous. The asymmetry in silver lies in the fact that its most explosive gains come when fear is highest. When trust in the system erodes, that's when the crowd is running in the opposite direction. If you understand the underlying principles of how debt cycles and money creation work, you'll realize that those moments of panic are not random. They're mechanical outcomes of a system stretched beyond balance. You can't rely on prediction, you rely on principles. One of those principles is that liquidity always hides fragility. As long as money is being printed, asset prices appear stable and people feel confident. But once liquidity dries up, fragility reveals itself. The assets most exposed to debt and leverage collapse first. That's when real tangible stores of value like silver start to shine. It's not because of magic. It's because they're nobody's liability. They exist outside the system that's unraveling. The asymmetry here comes from how small the silver market is relative to the scale of global liquidity. When trillions of dollars of capital look for safety, even a tiny reallocation into silver can cause massive price dislocations. This is what happened in the late 1970s and again in 2011. In both cases, silver wasn't driving the narrative. It was reacting to it, but because its market is thin and its float limited, small inflows produced outsized moves. That structural imbalance remains today, and in fact, it's even more pronounced. Another element of asymmetry lies in the psychology of crowds. During bull markets and equities and real estate, people dismiss silver as archaic. It doesn't generate cash flow. It doesn't pay dividends. But those are precisely the reasons it becomes valuable during periods of financial stress. It doesn't rely on someone else's promise. When everything else is built on debt, leverage, and assumptions, silver's simplicity becomes its strength. It doesn't have counterparty risk. It's not someone else's liability. That's why it serves as optionality against systemic fragility. You must, however, approach this idea with humility. Asymmetry only works when the cost of being wrong is small. That means sizing your exposure carefully. Most people fail not because their thesis is wrong, but because their position sizing is reckless. They bet too much on an idea and cannot survive when volatility moves against them. If you treat silver as insurance, something that doesn't need to perform immediately, but protects you when other assets fail, you'll position yourself intelligently. This mindset requires discipline. When markets are calm and other assets are rising, it's easy to forget why you own something that seems stagnant, but that's the nature of insurance. It feels unnecessary until it becomes indispensable. The paradox of optionality is that it looks foolish in hindsight during calm periods, but brilliant when chaos hits. That's why so few people use it effectively. Human psychology isn't wired to value protection during peace. What's happening now in the global economy is a buildup of tail risk, the kind of risk that doesn't show up in day-to-day market movements, but accumulates quietly in the structure of the system. Debt levels